Okay, so when we left off, we were looking at the asset section of the balance sheet. And a lot of times the asset section is called the left-hand side of the balance sheet. The liabilities and equity section is called the right-hand side. And it's less about having your balance sheet set up on a left and right-hand spectrum, but more about a reference to the accounting equation. Assets equals liabilities plus equity. So assets are on the left-hand side, liabilities and equity are on the right-hand side. So under the distinctions of liabilities and equity, we have fewer categorizations than we do in assets, and the playing field is a lot more simple. With liabilities, we break them simply into current and long-term liabilities. And the distinction is typically that for a current liability, we expect to liquidate those current liabilities with the use of current assets or the creation of other current liabilities. Now, a mistaken concept is that that current liabilities are something we're going to be settling within the reporting period or within the year or the operating cycle, whichever is longer. However, when we're looking at current liabilities, the true definition is that whether or not we're going to use a current asset or create another current liability in order to get rid of them. And I'll return to that in a second. So what are the typical types of current liabilities we see? We see a lot of payable accounts, accounts payable, wages payable, taxes payable. So these result from the acquisition of goods and services. We have accounts payable with our suppliers. We get inventory by buying things on credit. We might owe our employees wages. Taxes clearly become payable at the end of the year when we assess a tax expense. So all those accrued liabilities, I'll give them a different name, accrued liabilities. Because a lot of times you'll see that on a company's balance sheet as their current assets. And typically that's what they're referring to, are interest payable, accounts payable, wages payable, etc. The unearned revenues are items that we have received money for, but we have yet to deliver goods or perform services. So unearned rent revenue, unearned subscription revenue, and it could be short or long term, depending on whether we're going to be delivering these things beyond a year or the firm's operating cycle. So we may have an agreement or a contract in which some of the deferred revenues are current, whereas the ones we will be delivering beyond the period, the next period, would be considered long-term. Another current liability we see a lot is short-term maturities of long-term debt. Now, debt will mature sometimes through an annuity or a series of installment payments. So you may have, say, $1 million that will be payable $100,000 every year for 10 years. And that would be every year $100,000 of that debt would become current, and the remaining amount that we have yet to pay would still be long-term. Notes payable are just short-term obligations rising from the purchase of equipment or inventory. They're a little different than accounts payable. Notes payable are formal written promises, typically with a stipulated interest rate, and are more legally enforceable than just an account. Accounts are typically taken out with companies we do business with a lot, and there's a certain trust that's already there. No interest rates, no formal note. And again, returning to this idea of a current liability as something that we are either going to liquidate with a current asset or the creation of another current liability, we need to recognize that the maturity date will not always dictate the difference between short and long-term liabilities. So I will give you an example. Short-term debt that's going to be refinanced with long-term debt would be classified as long-term debt. We're not paying with current assets or current liabilities. Since we're refinancing this short-term debt with a 5-year note, for example, that would be a liability that would be recorded as a long-term liability, not a short-term, even though the maturity is within a year. The intent to refinance trumps that maturity. Another deviation from this is that debt that becomes callable within the year is also expected to be called, whether or not management intends to, and is classified as short-term debt. Callable means that the company can buy back the debt. So, for example, we might have a 20-year loan, but it will become callable in 5 years. Once it becomes callable, even though there's still 15 years left on that loan, it becomes a current liability because of the callability option. So that's current liabilities. Long-term liabilities are those obligations which are expected to be liquidated or settled at some date beyond a year or an operating cycle. And as I alluded to before, we have different types of liabilities under this umbrella. We have financial liabilities, operating liabilities, and contingent liabilities. So we'll look at each one in turn. Financial liabilities are obligations that arise from financing situations, right, where we acquire assets of some sort. The issuance of bonds are made for cash. Long-term lease obligations are made to get assets that we have as leased assets. I should say probably more specifically fixed assets. And long-term notes payable are issued for sometimes the purchase of PP&E or sometimes just cash. So each of these is a way of financing a transaction, right? Not spending money, but either raising money through the issuance of bonds, not spending money to buy a fixed asset, but borrowing it and paying rental payments, or not paying for PP&E, or not raising our own money, but going to a bank to get money, or promising to pay someone in the future for PP&E that we purchased. Operating liabilities are items that just arise from the ordinary course of operations in an enterprise. Pension obligations would arise from promising our employees pension benefits. Accrued compensation or sick days or vacation days that employees earn because of different benefits at a job. Deferred income taxes. In this case, instead of a deferred tax asset, we have a deferred tax liability. And again, you'll talk about those in intermediate 2. Essentially, a deferred tax liability indicates that there is a difference between your book income and your taxable income, and that your future taxable income will be higher than your book income. But again, that's that's a concept that is pretty tricky even in intermediate 2, and not something you have to understand right now. Contingent liabilities are potential obligations that have yet to occur. So there's some sort of a trigger or an event that has to happen, or we must meet a threshold of probability in order to recognize the item on the balance sheet. So a product recall could be a contingent liability. A lawsuit, warranties are contingent liabilities that may be exercised by consumers in product returns or product repairs. Okay, so that's basically our liabilities. The stockholders' equity has a few more designations that you have to be aware of. We're going to break this down into 6 general areas. I just added one this year that I hadn't covered before, but that is increasingly common in the financial statements of companies that I've been looking at. Capital stock, or common or preferred stock. So this is just a general term for both common and preferred stock. Most companies, almost any publicly traded company will have common stock. Some companies will also have preferred stock. Remember that these stock accounts are valued at the par value of shares that have been sold on the public markets, and that the par value is not the amount that the shares are currently trading at. That is their market value. The amount that they're currently trading at is. So market value does not equal par value. Par value is just this arbitrary designation of value, and it has no current meaning in an economic context, except that the stock cannot trade below a par value. So what you see now is a lot of companies having, like a 0.00001 par value. That's like 0.001 not even a cent or a tenth of a cent or a hundredth or a thousand. It's a 10,000th of a cent. So they will essentially wipe out this designation and everything will be paid in capital. Okay. Under the capital stock, we do need to have a designation, and every balance sheet will have one, of shares authorized, issued, and outstanding. The par value amounts will be disclosed. And I do think that one of the companies that I have queued up for us is a par value of about that amount. So it's kind of funny. Any options on the stock need to be explained: convertibility, callability, redeemability. Those are going to typically be disclosed in the title on the balance sheet, or if not there, in the footnotes to the financial statements, because those are very important things to know about what options are on the stock, because that can influence their value. That can also influence a number of things that we would see, whether or not the stock may have to be bought back, whether it could be called by the stockholder. And so those are different things we want to take into consideration. Additional paid in capital is just the excess of the amount that is paid by an investor over the par value. So for example, if a stock issue for $20 a share, so that's what it's trading for on the market, and the par value is $2, then the APIC, which is the additional paid in capital, APIC, generated from this transaction would be $18 per share. If we're going to look at it from a journal entry, recall that any amount of cash, in this case, the $20 of cash that we got for selling that share of stock, would be recognized as common stock only at the par value. And then all the extra would go into additional paid in capital. And that's how we would journalize that transaction. Retained earnings. So remember that retained earnings of a corporation, and this is just a formula that should be ingrained in your head by now, I would hope. If not, put it in there, because you will be using it at some point throughout this course, and many points throughout this course. They're the undistributed earnings of a corporation. So it's all of the income earned by the company over its lifetime, less dividends paid by the company over its lifetime. So if we keep, recursively defining retained earnings, we could expand this beginning retained earnings to be the retained earnings beginning in the period prior plus net income in the period prior minus dividends in the year prior. And then that one would then be the retained earnings from two periods prior plus net income from 2 periods prior minus dividends from 2 periods prior, et cetera, right? Because this retained earnings beginning, say this was the beginning retained earnings for 2016, well, that was the ending retained earnings for 2015, and so we can keep recursively defining retained earnings. Another way of thinking about that is that retained earnings is going to be just the sum of all net income over time minus the sum of all dividends that have been paid over the life of the firm. Sometimes we'll see a disclosure of appropriated versus unappropriated retained earnings. Unappropriated retained earnings are available for dividend payments, and appropriated retained earnings are restricted from dividend payments. Typically, these appropriations arise from debt covenants. So some debt will carry with it restrictions on when you can pay dividends or how much of your retained earnings can be paid as dividends, so that they can ensure that they will be receiving their interest payments in cash. Retained earnings is one of those accounts that doesn't have a normal, it has a normal credit balance. However, it can have a debit or a credit balance. A debit balance would mean that the company's in serious trouble, because if it has a debit balance, they've had a string of sustained losses. If retained earnings has a debit balance, no dividends can be paid to stockholders. One of the accounts that pops up in stockholders' equity that's a little less common or less known, because it's not just something that you always hear about, is treasury stock. Treasury stock is a contra equity account, contra SHE account. So that means that it goes opposite of stockholders' equity accounts. What is treasury stock? Well, treasury stock is shares of the reporting company's stock that have been repurchased by the reporting company from its shareholders. So we at one time issued stock. Now we bought it back. Once we buy it back, it becomes treasury stock. It's going to be valued at the price that was paid for the shares by the reporting company when they were repurchased. And it reduces the total amount of shareholders' equity because it is a contra shareholders' equity account. Now, the item that I added is non-controlling interest. It was formerly called minority interest. So if you see something that refers to minority interests, this is what we're talking about. These are corporate investments by the company that we're reporting for, in which they have a majority ownership. Now, when we have a majority ownership of another company, right, an investment in another company with majority ownership, that means that we consolidate all of the assets and liabilities into the reporting company on the balance sheet of the reporting company. So, for example, Company A owns 60% of Company B. Well, that means that on Company A's balance sheet, since they own more than 50% of Company B, they would consolidate the financial statements of Company A and Company B into their financial statements. So they would report the assets of Company B, the liabilities of Company B. Now, the interesting thing about non-controlling interest is that they do not have complete ownership. There's less than 100% complete ownership. So while they are consolidating the entire amount or the entirety of their investee into their own financial statements, they also have to recognize that there is not 100% controllership. And so the amount of non-controlling interest represents the amount that we do not own. So in the case of Company A owning 60% of Company B, well, someone else owns 40% of Company B. Those are the minority interests, and we would report those as equity. Accumulated other comprehensive income is another designation in stockholders' equity, and this is going to be very similar to retained earnings. We're going to revisit this guy in Chapter 4 when we talk about the income statement, but it's very similar to retained earnings. It is a place where we accumulate other comprehensive income gains and losses over time. And these are just gains and losses that we do not include in net income because we want to reduce the volatility of net income. OCI, gains and losses, other comprehensive income gains and losses, are not going to be included in net income. So they're not close to retained earnings. So the idea is you have sales, a lot of other stuff down to net income. After you have net income, you then have these other comprehensive gains and losses, and then you have what we call comprehensive income. Well, all of this net income is close to retained earnings. This OCI stuff is close to accumulated other comprehensive income. So we have two different stopping grounds for all the revenues and expenses that ended up in net income. They go to retained earnings. Anything that happened after net income, OCI, gains and losses, goes to AOCI. So like I said, it's very similar to retained earnings. It just accumulates different items, and we will talk more about it. It may have either a debit or a credit balance, just like retained earnings. So let's look at some additional financial disclosures in the annual report. And this sort of brings up a topic about my vernacular that I use whenever we're talking about financial treatment, disclosure versus recognition, right? When we use the term disclose, what we mean is that typically, and this is more the case 90% of the time, that if we're just disclosing something, it means that it's in the footnotes to the financial statements. It may or may not be reflected in numerical values of the financials. So if I'm just disclosing a contingency or a covenant, that means that I'm making a textual reference to it in the footnotes. That does not necessarily mean that there are any numbers that would inform me that these covenants or contingencies arise from the financial statements themselves. Now, when I use the term recognize, sometimes incur is a sort of synonymous with recognize. And typically we talk about incurring expenses, but we also recognize expenses. This implies that the information is contained in the financial statements. So when we recognize something, it means much more than just a footnote disclosure. Okay? It affects numerical values and measurements. All things equal, the recognition is going to be considered a much more rigorous treatment and call attention to financial statement users, right? Something can be buried in the footnotes, and it's harder for financial statement users to really appreciate the severity of something or to perhaps even find it. I mean, amongst a 90-page disclosure, if you're invested in a lot of companies, it can be pretty hard to find these items. But if they're recognized in the financial statements, it's a much more rigorous treatment where numerical values are actually affected. So let's talk about what is in those footnotes. What is disclosed? There's a great deal of information. You know, I pulled up that financial statement for you guys in class, and as I showed you, you know, there's a good 30 to 40 pages of footnotes that you have to wade through in order to really get a good idea of what those numbers on the financial statements mean. There are, you know, a lot of complex accounts. Pension plans have a lot of footnote disclosures. Leases have a lot of footnote disclosures. Long-term debt has contractual provisions. You know, you just get a summary number, but that's, you know, probably 5 to 10 debt issues that have various maturities, various interest rates, various debt covenants. All of this stuff has a lot of complexity that you only will appreciate if you look into the footnotes of the companies. That being said, there are specific ones that are made by all companies. For example, significant accounting policies is something that is typically the first footnote where the company discuss how they apply depreciation, how they apply revenue recognition, very big overall guiding factors in how the company accounts for items, depreciation methods, inventory cost assumptions, things like that. Every annual report has to have this, and it's usually the first one that we see in the footnotes, the first footnote. Subsequent events refer to anything that happens between the fiscal year end and the publication of the financial statements. It's typically a 3-month window. December 31st fiscal year ends. Their reports are made public around the beginning of March. And so that leaves an amount of time in which, you know, the reports are being audited and are in press, and when something could happen. So when that does happen, and the event is material or affects the financial position of the company, then it needs to be disclosed. So this is another footnote that will be present if there is a subsequent event that we want to call the investor's attention to. So maybe a recall or a lawsuit, the disposal of a major asset or a division of the company, or if the company went and raised more equity, had what we call a seasoned equity offering, or issued additional debt. Those would be all extremely material items to report in subsequent events. Related party transactions are any transactions that the company instigates with someone, for example, an owner or manager or a company affiliate. These transactions will likely have a departure from normal business transactions. It's not as if you're contracting with someone who is purely independent. If it's a related party, then you're probably going to have favorable terms. And so we want to make sure we call attention to that and demonstrate that this is not something in the normal course of business. Separate from the footnotes is management's discussion and analysis. It's abbreviated the MD&A. It's just the summary of what management thinks about the current and future operations of the company. It could be considered biased. They contain an insider's view, so they are valuable. You do have to take them with a small grain of salt because the manager is going to typically describe things as pleasantly as possible. They could describe why they decided to issue a dividend, why they want to repurchase shares. Maybe they're going to involve an equity issue, and they can talk about, the projects they have lined up for the financing that is going to be raised from those items. Any sort of new developments or planned expansions they'll talk about, or maybe they'll talk about the fact that they had a poor quarterly showing, that maybe there was some extraordinary event that happened that caused their earnings to be depressed for a number of months, but that the investors should have no worries in the long run, things of that nature. After SOX, post-SOX, we now have this summary of management's responsibilities. It's something that came around because we decided that the CEOs and the CFOs needed to be held to the fire when it came to safeguarding the integrity of the financial statements and the financial reporting mechanism. So a lot of this will be talking about not only the responsibilities of management, but perhaps their independence, their expertise, and also the independence of Audit Committee members. The Audit Committee is a committee of the board of executives that meets with the external auditors, hires the external auditors, and works with providing information to those auditors. So there's a lot of stuff that is inside this management responsibilities. It also talks about corporate governance mechanisms that ensure, again, the integrity of the financial reporting system, so that not one person can unduly influence items and bias the reports that we see within the company. It also has the CEO and the CFO sign off on the validity and the veracity of the financial statements, so that puts them in the hot seat. If anything happens, then they can be held accountable in court. Also, last but not least, the auditor's report is a part of the financial report. It's something that is highly stylized, which means that essentially they are depending on the type that you get, qualified, adverse, unqualified, disclaimer, it has a very set, specific text that it follows. It records the audit opinion, which is, think of it as the final grade that the auditor is giving the firm. Unqualified represents no departures from GAAP, so that's like an A. Qualified has a small infraction, but not enough to invalidate the financial statements overall. So now we're talking about C+ maybe, but not something that is going to radically affect the firm's operations such that they need to have a restatement. Adverse, rare, and serious cases. So the adverse opinion means that there were serious departures from GAAP and the disclosure of items is markedly insufficient, which is an F. And then a disclaimer would be when insufficient evidence is received to render an opinion. So sort of the jury's out, or maybe an incomplete, if we're going to go with this whole final grade idea. So that is the balance sheet and its related disclosures. We will meet you on Thursday and go over these problems, and I hope that this all makes good sense. Thank you.